Bitcoin is a risk-off asset, meaning a safe haven asset. For people who do not buy into that mindset yet, who look at Bitcoin more as a way to diversify their portfolio, in 2012, there was no cryptocurrency. There was just Bitcoin and the Bitcoin network. For me, it was really understanding, until I started working in finance, I really did not understand how financial institutions worked. If you think about the way we interact with financial intermediaries, really the role they play in our lives did take all of this complexity happening behind the scenes and they abstract it away. And we trust these intermediaries to do what is best on our behalf and to manage all of this complexity. And what was so interesting to me about Bitcoin is Bitcoin said the opposite. It said, do not trust, don't hide all of the complex bits and pieces, don't hide the risk, put it all up front and center on this public ledger, the Bitcoin blockchain, and put it all on the end user. And so for me, it was just the start of a very long intellectual exploration into topics like Austrian economics and what makes sound hard money, what imbues things with value. And then as we looked at what was happening in the macro landscape, growing up in the shadow of 2008, the financial crisis, right as I was entering the workforce in corporate finance and M&A, obviously the world experienced this seismic shift. And so I think a lot of people of my generation just found it very, very fascinating at a time when so many things that we had grown up trusting. Sure. So I think the biggest thing that's happening as we look at the world is $13 trillion of negative yielding debt. That's insane. Okay, in the US, we're in the longest economic expansion ever. Central banks are printing more money than ever. The indebtedness ratio is rising more than ever. Here in the US, Congress just approved more budget hikes, right? More debt. And so I think everyone in the world is asking, well, what happens in a world where we have negative yielding debt, in a world where the return to labor is effectively zero and all of the return is returned to capital? How is this going to persist? But if you think of Bitcoin as a form of digital gold, as the digital analog for something like gold that has tremendous amount of societal value, but also a lot of these features of hard money that make it so attractive, it makes Bitcoin and cryptocurrencies extremely attractive. One of the key challenges here that I try to avoid is psychological anchoring, right? So even by calling Bitcoin digital gold, I'm engaging in a form of anchoring. But one interesting way for me to think about it is there are cryptocurrencies like Bitcoin, and really Bitcoin is the dominant one. It's nearly 70% of the total market. It's by far the largest, most established, best known cryptocurrency. And what's unique about something like Bitcoin, there's three primary features that make it really special. Number one is that it's permissionless. Anyone, anywhere can enter or leave the Bitcoin network. All you need is an internet connection and the copy of the Bitcoin code that you can run. So this nature of it that is permissionless and anyone can interact with it's really powerful. The second component is it's decentralized, meaning no one entity or no one person has the ability to censor or block transactions on the Bitcoin network. So that nature in and of itself makes it tremendously interesting, makes it tremendously valuable. And then the last component is that Bitcoin is not backed by anything. It is a digital commodity that is backed by nothing but its own scarcity and the demand for that digital scarcity.
So is Bitcoin a risk asset or a flight to quality asset?
So great question, and I think there's two different things going on here. So number one is we look at the growth of gold as an asset class. If we look at the advent of gold products, right, gold didn't really become a large asset class until we started to see the introduction of products that disintermediated the need for people to physically custody gold. So in reality, if we look at the gold market over the last 20 years, the physically traded volume of gold has stayed fairly constant. It's not increased much or decreased much, but the volume of futures, derivatives, and synthetic representations through productization of gold have increased 30-fold, right? So a lot of the growth in the gold market that has made it a $7 trillion asset class hasn't come through fundamental change in the demand for physical gold has been the proliferation of products that enable investors to easily add or subtract gold exposure through a variety of different constructions. Similarly, the phase we're at with Bitcoin right now, the majority of people who hold Bitcoin already buy into many of the ideas I've sort of shared with you today, that Bitcoin is sort of this durable, immutable, decentralized store of value asset. Bitcoin is a risk-off asset, meaning a safe haven asset. For people who do not buy into that mindset yet, who look at Bitcoin more as a way to diversify their portfolio and add this binary, really asymmetrical risk-reward option really to their portfolio, they view it as a risk-off asset. It's highly speculative in nature. It's either going to be zero or it's going to be a whole lot more than zero. And so I think it really depends on the type of person we're talking about. But for myself, certainly, I view Bitcoin as a safe haven asset. And again, it's important to separate here, between the volatility of the asset and the cyclical trend versus the secular trend, which has been up and to the right. If we look at the sort of broader, longer-term secular trend and the appreciation potential of something like a Bitcoin to become a gold, I think a lot of people are looking at that aspect and deciding this is something I do want to hold in a world where things feel increasingly challenging. Absolutely. So I think the fundamental challenge for regulation is historically the way that regulatory jurisdiction would have been determined is by physical borders and physical boundaries. When we look at something like Bitcoin, which is three things, right? It's code, it's a network of computers around the world that run the Bitcoin code, the Bitcoin network, and then it's an asset itself. The challenge is that something like Bitcoin doesn't fit into the concept of physical borders of the past. It's supranational, it's digital and fluid in nature, and it doesn't rely on intermediaries the way that a share of a Spider Gold ETF might, right? You're not going to your Fidelity account and trading it. You can't really regulate the Bitcoin network. Its whole nature is to be open and permissionless. Anyone can run it, anyone can use it. And so really what they're regulating is companies that sit on top of the Bitcoin network and provide products and services to consumers in different jurisdictions. And so the challenge for regulators is how do you create a regulatory paradigm that caters to some of the unique features of this asset and of this technology that we haven't really seen before. And I think the second component that's challenging to sort of come to grips with is historically everything we do in the world of finance relies on intermediaries. That's where regulation is typically applied,